Okay, so today we'll look at how to establish the assumption for a right of use assets. So, and in order to understand the basis behind the right of use assets and its attendant depreciation, it is important for you to understand how right of use asset emanates. So right of use asset emanates from the IFRS 16, which is the IFRS on lease. Okay, so IFRS 16 actually um, line out how a lease should be actually recognized in the financial statements. So when we understand what the financial reporting guys did on the face of the financial statement, we better have a good understanding of how to actually forecast the numbers. All right, so IFRS 16 is, like I said, is on lease, and it was introduced in January 2016, which talks about what a lease is, that a lease is an agreement whereby the lessor, which is the owner of the asset, convey to the lessee, the user of the asset, the right to use an asset for an agreed period of time in return for a payment or series of payments. So the payment is actually the consideration in a contract. So in contract, there needs to be an offer and acceptance. So the offer is the right to use the asset, and the acceptance is in form of you paying a consideration to actually um, show your acceptance of that offer. Okay, so it means that there is a contract when you have the right to use an asset is given, as well as there is a payment that is made. All right. So before now, we used to apply IS 17 to leases. Um, and the treatment of lease in IFRS 16 and IS 17, it actually have a difference in terms of the definition. You know, IS 17 talks about risks and reward of ownership being transferred, you know. But here we are not looking at whether ownership has transferred or not, but then we are looking at, is there a contract giving a right to use, and payment made in consonant with those rights. So a better understanding of how IFRS 16 will treat the asset in a lease from the angle of a lessee will actually give us, as analysts, a clear view of how to predict and how to forecast the numbers. So I have a little sample here, which I want to use to explain um, what numbers can actually be our assumptions regarding lease. So one of the things that IFRS 16 brought is that for you to determine the value of the lease or the value of the asset in a lease, you need to discount the payments, the series of payments made over the terms of the lease. So into by using the present value, the discount factor, you know. So that will give you the value of the asset in a lease, which also connotes the lease liability. So you are debiting the assets, which is the right of use asset, and you are crediting the lease liability. So when payments are made on a monthly basis or instrumental basis, the lease liability is then reduced until the end of the lease term, when the lease liability turns to zero. But in terms of the value of the assets, it is depreciated over the the lower of the lease term or the asset useful life. But where you do not have the asset useful life, you make do with the lease period. Okay, so in this case, we've got the discount rate that is implicit in the lease, the escalation factor, which is like the inflation rate, then the period of the lease is 7 years. Then we've got rental payment that will be made is 6,000. All right, so here I've created the timeline of the model in terms of 0. Then I did 0 plus 1 and drag it forward to give a 10-year period. Yeah. Then I also did a timing flag here, where what I flag is when the 7 years, what are the period that will be covered in the period of the lease that will be exactly in line with the period of the lease. So I use a less than or equal to here, and I use an and to give a second logical, which I said this value must not be equal to 0. This value not equal to 0. So on 0, and I multiply by 1. So when both of these logic are true and multiply by 1, it gives me 1. But if any of them are not true, if any of them is false, if you multiply by 1, it's going to give you 0. So, and you see what I've been able to achieve. So I've got 1 in the period of the lease, while any other period is 0. So that's the timing flag there. Then escalation factor. So year on year is going to increase by inflation rate um, is increasing by 3%. So that 3%, we use the normal formula of 1 plus inflation raised to power the number of years. So that's exactly what I did here. So the 1 plus the inflation rate of 3%, all bracket raised to power the period you have, you know. So that's how we got all these numbers increasing by 3% annually. Okay, then the next one is the discount factor itself. So the discount factor is going to be 1 plus the discount rate of 5% raised to power minus the period of the year you are in, so that you are discounting from that year to year 0. So that's the discounting factor formula. And you can see as you move into the years, the value of money decreases to 95, to 91, 86, like that. So the farther you are, the lesser the value of money in today's time, in year 0, which is 1 era, declines. So that's discount factor. Then here we've got the rental payment. So the rental payment, what I did here is to multiply the rental payment of 6,000 by the timing flag, so that the 6,000 will only occur in the period of the lease. You can see here. Then, so that I call the real rental payment that has no effect of inflation, you know. But with the effect of inflation, which is the nominal rental payment, meaning that we are going to multiply this by our inflation, our escalation, you know. So I'm multiplying 6,000 by the timing flag and by the escalation factor. So that gives me an increase. So you can see the value of money of 6,000 has increased to 6,180, and in this period 6,365. So inflation actually increased all these values. So then we have the discounted nominal lease payment. So this is the value that we want to discount now, you know, because the company is actually going to be facing inflation, and we have been able to project inflation into it. Then we also got so the discounted nominal lease payment is multiplied by the discount factor that we've got here. So the nominal rental payment multiplied by that gives us all these values, which occur in the period of the lease. So this is the present value. So the present value of all the lease payments made over the period of the lease is 38, you know, is 38 919. So this is the value of the assets as well as the value of the lease liability that will be recognized. So that's 683. Yes, depreciation. So the first posting that the financial reporting guys would do is to debit, so you can see it here, is to debit right of use asset and credit lease liability with that figure that we derive of 38,919, you know. So, and this is what is done here, debit this, so it increase right of use asset and credit lease liability, you know. So that's what is done. Afterwards, that you have done that, the payment that is made, you know, you then debit the lease liability in order to reduce the lease liability and credit cash. When where the company is the lessee and is making payment on the lease, the credit cash. So you can see that cash was paid. The cash paid was this nominal lease payments, which is 66180. You know, so this is equivalent to a nominal lease payments. You know, so when cash is paid, you credit your cash, and that's why this is negative, and we are debiting this lease liability. So you can see the movement there, that it is this lease payment that is actually reducing the value of the lease liability. Okay, so and that goes up to year 7 where it becomes 0. But another thing that happens is that the assets that has been recognized will be depreciated over the life of the over the lease period. So you debit the depreciation account and credit accumulated depreciation. So in the P&L, if you see this here, in the P&L we debit the depreciation. So the depreciation is just to divide the value of the asset by 7. So the value of the asset divided by 7, we only multiply with the timing flag so that it only occur during the period of the lease. So that's what we've got, and we've got accumulated depreciation here, you know, credited as well. So another thing that needs to be recognized is the interest, the implicit interest charge on the lease. So this as well is very important because the payment made by the lessee is composed of the principal and the interest, you know. So with this, we are going to apply the interest rate on the lease balance, the lease liability balance, you know. So if you look at how the interest charge is calculated here, it is the 5% multiplied by the value of the lease liability, you know. So the lease liability is multiplied by 5% for us to get our interest charge. Then if you look at the second one, F2, is still 5%, but the value of the lease now, because payment has been made, 6,180 has been made to reduce this. So the value of the lease becomes this, you know. So that's how we have gotten the interest that is implicit in it. But guess what? To get the value of the lease, two things are done. First, you have to subtract the lease payment. So the lease payment of 6,180 is actually being subtracted while you had the interest charge. The interest charge that we got is this, you know, because inside the lease payment you have the interest charge embedded in it already. So you need to only add the principal to the value of the lease liability at the beginning of the lease. So that's how we determine the balance of the lease liability. And so all these made the P&L to result into a loss. So that's a retained loss for us, which we need to accumulate, you know. So we had depreciation as an expense. We also have interest charge as an expense. So it all resulted into profit profit before tax of 7506. So assuming that we are not having any tax rate here, so that will then accumulate into retained earnings. So our retained earnings is this. So we are accumulating this figure plus whatever balance we have before this time. Okay, and that's exactly what we did here to balance before plus the value of the profit or loss during the current year. So that's how we got the retained earnings here. And so if you add the lease liability and the retained earnings together, you get the total equity and liability. Whereas if you come to the asset side, if you add the carrying amount or the net book value of the right of use asset and the cash, you're going to get the total assets. So total assets minus the total loan and liability, total equity and liability, you are going to have a nil. So this is how the financial reporting guys will treat a lease ordinarily. So what are the inputs to this lease? You've got the implicit interest discount rates, you've got the escalation factor, the lease term, and the rental payments. So if if it is a lease is a contract which we do not expect that these variables will change, because in modeling we are after a changing variable to use as our assumption. So the the factors that can change are these ones, you know, are these ones that can change. So the lease time might be extended to 10 years, you know, or let's say 8 years or 9 years. So it is expected that when you type 9 years, you should have um, the the model change, you know, just like I've changed that to 9, and you see a change here, why your model is still in balance, you know. So this is how it's actually, the lease can be applied to modeling, you know. The escalation factor can be 5%, can increase to 5%, and when you change, the variables in the model will change, you know. So now for an existing, so this can be really easy to apply for a startup, but for an established company who has already applied all these variables, and all that we are seeing in the statement of financial position are just the depreciation of the right of use, probably showing us the interest charge, interest implicit in the lease. So these are the things we need to look out for in an existing company's financial statement. Also, the value of the right of use, that's the net book value or the carrying amount, you know, and the cash payment made, you know. So this cash payment will be very difficult to see in most public limited publicly quoted companies, you know, to show the breakdown of each of their cash payments. So this will be very hard to see, but we always have this, the net book value of the right of use, and we'll also be provided with the lease liability value, you know. So like in the case of the Nestle we are looking at, they provided us with the lease liability and the right of use assets net book value, you know. So you can see that the value of the NBV of the net book value of right of use of 54,000 is completely different from the value of the lease liability as time goes on. So this is 54 at the onset, but in year 2 is 50,400. When you go to the net book value of assets is 48. Next year is 42, but here lease liability is 46. So this one is driven by payment made, while this one is driven by the depreciation that is charged based on the depreciation rate, you know, or the useful life of the asset or the lease term. So you can see that they are driven by different things, and that's why when we go into forecasting the net book value of right of use as well as the lease liability, it's going to be completely different ball game. All right, so I just hope that you understand that before we go into um, the case of Nestle. Thank you. Okay, so here we have come back to right of use asset as in the case of Nestle. So Nestle, um, we are here. So let me bring up the 2016 financials for Nestle. I mean 2021, which is the current, the latest financials. And I do a search on right of use. Right of use. So you see the depreciation of right of use, which is added together with that of PPE, which we have talked about before now. Acquisition, right of use, and PPE. So um, some write up on right of use, which you can read up. Right of use assets are depreciated over the shorter period of lease term, so you can see that. Okay, so I'm going to the notes to see the breakdown of right of use. So you can see right of use asset schedule here. So the items that are actually um, used for the lease are land and building. So those are the assets um, that are in the lease. Okay, so I'm going to concentrate on 2021. So 1st January 2021, they had the land of this in the lease and the building of this in the lease. Then they had an addition, modification, disposal, and here they've got the balance. And so what we did in the model is to bring the net book value of the right of use, which is 48848, you know, which we can get. Let me close this so that this will not obstruct. So 4848732. So which is 2021 balance of right of use. Okay, so I guess there are some deductions here and there. Let's see towards the ending part. Okay, so this is the value. So I think that I'm looking at the costs. This is the cost. This is the depreciation, accumulated depreciation area, and this is the net book value. This is the net book value area, you know. 2020 depreciation, 2021 depreciation, and here we have cost 2020 and cost 2021. So we go to the net book value area, which is towards the end, which is 2021. We've got 484,732. So that's the value of the right that is remaining to be depreciated. So that's how we got that. Also, the depreciation during the year, for that 4426264. So if you come up a bit, 2020 depreciation 44264, you know, this is the depreciation charge in 2021, you know. So if you look at this depreciation charge in 2020. So we are looking at this depreciation against the net book value of the right of use. So in a nutshell, if we continue to charge this amount on a yearly basis, how many years will it exhaust this net book value? to be fully depreciated. So in order to get that, it's just for us to do a division by saying um, the depreciation charge annually divided by the value of the net book value remaining on the assets. So you are going to get a percentage. So that percentage we turn it to a value, useful life. So how do we do that? We take 100 and divide by that depreciation amount, depreciation rate, and also in trying to remove the percentage on the depreciation rate, that's why we multiply by 100, so that it will give us, if it is 5%, it will just give us only 5. So 100 divided by 5 will then give us the useful life of 10.9 years. So this is 10.9 years, and I did I mean a formula here that shows when this asset, if we start depreciating this asset on these dates, it will the depreciation should end on this date, 30th November 2032. So this is a bit of a date. I use a date function here, a date function, where what I'm doing is just to say the year where we are going to start, which is this L5, you know the model start period. I'm extracting the year out of this, which is 2022. So this will give me 2022. Then I also want to add it with the number of years it will take the asset to be depreciated, 10 years. So I link to this 10.9 years, but I use a function called int to extract only the integer, which is 10, because this is 10.91. So I only want the whole digit, which is 10, to be extracted. That's why I use int here. And so what int will do is to just extract the integer out of that number. So it will give 10. So 10 plus 2022 will give us 2032. So that's what that is doing. Then in a date function, I also use a month, because the next argument uh, for a date function is months. So I also use month and extract the month number from L5, which is January. And I added the months because the 0.91 is what is remaining here. So 0.91 converted to months, multiply that by 12, you know. So that will then give me um, the number of months I need to add with this beginning month of January. So that gives me the month. Then the day, I also use a day function here. So I played with a bit of doing the minus 10.91 minus 10, things like that. So that's what I did there to actually got the ending date. But this is just for knowing sake. We are going to, what we are going to do is to flag it on the model timeline, to flag when the depreciation will begin and when it will end on the model timeline. So it is expected for you to actually know this beforehand. You know. So we have been able to get the remaining useful life on the right of use assets, as well as the value of the net book value that we are going to continue to depreciate. All right. So talking about the new acquisition of right of use assets. So this is the new acquisition they had in 2021. But that's not to say that this acquisition is going to continue going forward. So because we are not privy to that information, we may not forecast the new addition for right of use assets, because a new addition for right of use asset means that there's going to be a new lease agreement, new lease contract entered into. So if you are modeling for a company of this nature and we don't have such information, it is better to stay out of that. But where we have we are privy to internal information as to the the new lease contract they are entering into, yes, we can then project it under the new acquisition. All right. So that's that about the right of use assets. I hope that assumption is clear, you know. So we've projected for 10.91 as a remaining useful life. So it is expected that this kind of assumptions or drivers, they are constant over the number of years. So it is better typed into this place. So what I'm going to do in order to get the correct, okay, 10.91. So I just put that here, give it a double decimal, and I will say this is years, you know. Then um, the value of the lease, the value of the asset on the lease, which is this. So it's better I come here and this one is this. So this is what I need. I use this to compute this. Okay, so this is amounts. Maybe we need to do 1,000 naira like this instead of we having this where is that figure in thousands of naira on top, so that we know these are in thousands of naira. Okay, so this is what I need, and I can click this and do my OT6 on it so that I apply the formatting for assumption. So that I know that's what is driving me. So let me do for this as well. Okay, so for this one, I need to move these ones out. I need to move these ones out. Then I need to move this in, which is okay. So all these are percents. And D. So at 6 and assume. I'm trying to get how we got this. Okay, by the revenue. So these are new additions. The percentage of revenue. So I don't need these figures. Review, review, delete the comments, then okay, we also have asset useful life here, which is very important to what we are trying to do. I'll copy this. I'll copy this and paste it here. cut this, place it here. So this one can be deleted. So these are inputs. These are inputs at 6. It's part of our assumptions. So this percentage will be applied on revenue. Let me pick this and replace it with this. No. Cut this. Where can I paste this? Let me paste it here. Then take this, cut and paste down. Cut, paste. Okay. So it's better this way. So I'm doing some cleaning up on the asset side. Okay. Under this area too, we need to do some movement things like this. Cut, paste it here. What do we need? We need an MBV. Cut and paste it here. So these are all picked from the historicals. Then these ones we calculated it, so they are part of our assumption, but we have used these two to actually get that. Paste. I would like to have this cut placed here. Copy. $28.2. 8.8, or let me just copy and paste as values. Copy, paste as values at ESV. And at 6, these are assumptions. I think we're done. So these are constant assumptions, so they are not expected to reflect under the forecast period. They are constant for every year. Okay, so what other ones? So I think we are clear now as to right of use, all the assets, long-term assets, except for the working capital. So I'll see you in the next video for working capital. Thank you.